Our first panel of the afternoon focuses specifically on factor investing. It features three practitioners whom we're very glad to have. First, we're very glad to have Rob Gillam, who you will see on your far left, who's Chief Investment Officer of McKinley Capital. Rob has his undergraduate degree from Wharton, and at McKinley he's responsible for investment research, trading, and portfolio management, headquartered in Anchorage, Alaska. McKinley manages more than $8 billion for mostly institutional clients, and I also note that Rob very generously serves on our board and has for a number of years now. Rob, thanks for coming. Our second panelist, directly to Rob's left, is Syed Haque, who's Director of Public Markets at UPS Investment Group. He and the UPS team have oversight of about $30 billion of defined benefit and other asset in the pension group. Syed came to UPS from the Emory Endowment to manage the global equity portfolio at UPS. A pleasure to have you here, Syed. Our third panelist, to your far right, is Jeffrey Saret of Two Sigma Investments. He joined Two Sigma in 2012 after 4 years in McKinsey's economic practice. He has a PhD from Berkeley. Two Sigma, as many of you know, is a tech-focused investment firm with a learning and teaching culture. That's only natural, as the firm's co-founders are both quants and D.E. Shaw vets. The firm manages more than $25 billion. Jeff, thanks for coming. Gentlemen, I'd like to start by asking each of you to describe, first in general and then specific terms, for our audience the context in which you work and how the idea of factor-based investing is incorporated. Rob?
Sure, well, thanks for having us. So I think it's probably most important to note, just as a quick diversion, that how many conferences do you go to in the investment world where you spend 90% of the time flogging yourself for all the things you don't know, or the correlations or the T-stats that are false. You don't see that at Irisone, or you don't see that at SALT. So it's nice to be part of a self-reflective type of group. So in terms of us for factors, we think about them in a bunch of different ways. We try to think about coming up with unique definitions for more fundamentally driven, or you might, given some of the previous discussion, think about rationally explained factors, trying to get some sort of asset selection type effect. We think about it in terms of combinations of factors. Of course, value and momentum probably being the most commonly known paired of the various factors, but perhaps some other ones as well, serving as good correlation pairs. I'm sure everyone here thinks in terms of dynamic weighting of factors, and then sort of lastly, the use of factors across different asset classes. So those are some of the ways that we think about it at McKinley.
So UPS Group Trust, I might give a bit overview of that. So it's an open plan, defined benefit. There's not many plans left that large are open. Liability duration is about 17 years. So that gives you another idea. One of the highest expected return in the industry, 8.75. So that way you can see that it's an open plan, very high expected return, and a very long duration. So, and the way the portfolio is that we have a return-seeking portfolio, and then we have a liability hedging portfolio, and then in the third bucket we have a risk insurance, which we have, because of the short-term constraint that we feel, whether it's funding status and all that, how do we manage that? So coming back to on the risk-taking portfolio, the global equities are roughly about 40% of the portfolio. And overall, we have looked at factors, again, not as many as 300, we don't have the resources and the bandwidth or the skill set to know 300 factors, but we have looked at the 4 or 5 factors. Some of them are, we discussed value, quality, low vol, and then a small cap momentum, and some of them we have implemented also. Again, looking at for us is that how does it overall works with our liabilities, also very important part. And again, the ease of implementation of these things, whether, on what scale we can do these things. So these are the things we look at.
Thank you. So as you mentioned, Two Sigma is a technology-driven company. We think, well, let me start with my role at Two Sigma is in thematic research, and the goal of that is to think about research questions from the asset allocator's perspective, not so much how do we generate short-term alpha, but how do we solve the problems that asset allocators are thinking about. And among other things, that led to us exploring the opportunity to figure out whether we could deliver, or at least help deliver, risk factor exposures and measure it. And that gets to the other angle at which we kind of look at it, which is what risks exist in a risk factor, and are those the types of risks that, from an asset allocator's perspective, can offer a long-term premium?
Okay, so far today we've heard quite a bit about really both constructive evidence as well as an important set of warnings about factor selection and implementation. When you think of the correlates in returns, what rises to the status of a so-called factor? Do they represent risk to you in the paradigm in which you operate? What's your decision function? Now I understand I'm trifurcating a question, so that is question asking 101 failure. But what is the story to you? And I'm going to ask Syed to start.
So overall, the market is the biggest factor. So we are there again. There is a risk premium. That's why we have invested. Beyond that, again, what's the economic intuition? Or again, if we are getting some returns, there must be some risk I'm taking. And and again, is it worth taking for us in that sense that how does it behave when my times are bad? And there are some payments, there are some form of bad times, and again, payment for that. If those bad times happen when I really need return, do I need those factors? So we look at that. And again, one of the reasons we have a low wall bias, because I think it does well when our it's somehow of all the, compared to the markets, relative to the market, the correlation to the liability, low wall is generally better when the liability is doing better. So we look at these things. And overall, from a whole, again, can we, through these factors, enhance our returns? So these are some of the reasons.
So I'd reiterate that a lot of what Syed said is similar to the way we're thinking about it. The nuance that I would add to it is there are, well, depending on who you ask, there might be an infinite number of risk factors. What you really want to think about from a practitioner perspective is which factors are generating a premium. In other words, to what extent are they generating returns in excess of whatever benchmark you want to choose, risk-free rate or other factors. And two, is that premium fairly compensated for the types of risks you're taking? In other words, I think of a lot of risk factor investing as what qualifies as an attractive risk factor. It's whether the expected return is justified by the inherent risk that we're taking in it.
Let's refine the question. Should asset owners, many of whom are represented in this, or within this audience on a percentage basis, many of it is represented, should they be constructing portfolios with factor diversification in mind? The old phrase that so many in the consultant industry know derives from Brinson, Hood, and Biebauer in '86 in the Financial Analyst Journal, suggesting that 93.6% of the risk of a portfolio comes from asset allocation. Should they be starting there, or they should be starting with risk factor diversification? At what level should they be thinking about this? Is it additive to a given asset class? Is it at the portfolio design level? What's your current view and what's your recommendation when clients ask? And maybe we'll start with Jeff and go down.
So there's what I would consider the academically pure answer. So if we could start with a blank slate, how would I think about it? I would think about it in risk terms. What risks exist in the market? Which of those make the most sense to put together in an attractive way? And that, there's a long history of thinking about that. One manifestation of it is the separation of alpha and beta. But to me, it's to construct a portfolio, you are constructing a portfolio out of risks. Now that's as I said, the academically pure answer, at least from my perspective. What we hear a lot when I talk to asset owners is that that's not possible. First, they think of their portfolio, and Syed, please correct me here. First, they think of their portfolio, then they might map it into risks, then they might map it into asset classes, and then they have to go from asset class first to what risks are embedded. And we had an interesting conversation with an asset owner a little while ago, or not so far, a few days ago, and he said that he understands the academically pure answer, but he still has to go explain to the board that here's the tilts that he's taking, and that's inherently relative to existing asset classes. And he asked whether a simple index version of this would be a lot cheaper, even if it's a lot less efficient than thinking about his overall portfolio in asset risk terms.
So in our case, I would say the risk factors in terms of overall, yes, we talk about it, but as far as implementation-wise, no. We get to the asset level, so whether it's you're talking in the fixed income side or the equity side, once we have an allocation decision, and that's pretty strategic asset allocation, which doesn't change it much. It's pretty static, somewhat, and there is a process you have to change that. So once you have a asset allocation, within that, then we do look at the factors. Okay, in the equity world, what are the factors, and why should we own them, or can we own them also? Given, what are the limitations? So that's how we go about. Like in the fixed income market, we haven't done much because it's not easy. Again, some of these are not that easily applicable also. So.
Without putting anyone specific on the spot, for example, you're a consultant. When you hear and interact with the consultant industry or segment of the market in practice, are they speaking factor language today, or are they speaking asset class language?
We don't have consultants, I can't say per se.
That's a safe question then.
I think generally they, I don't know, to be frank with you.
Yeah. Okay, Rob?
I was just going to say, I think it starts with a slide that Mark put up a little bit earlier, and this is what's the goal, right? The goal is to generate future performance. So I think it starts with the asset owner. Your perspective with UPS, for example, with some of the statistics that you just heard here about the duration and the return goal could be very different than a private client who's simply trying not to have his money confiscated by the government of Venezuela. So I think it starts a little bit with what's your goal? And once you get your goal, then, what's the least amount of risk that I can take to get there? And then most importantly, and what we tell, our clients and some of the consultants that you refer to is, bet on what you know, and make sure, factor work really can help you understand bets maybe you didn't intend to make and try to take those off. And that's how we sort of think of the paradigm of factor investing, is focusing on what you know and avoiding what you don't.
Mm-hmm. And within your practice, do you focus on classes of assets and then drivers, or do you start with drivers and then build that around different asset classes?
Well, we're stuck with the asset class we started with, which is predominantly equities and equity alternatives, so we sort of start there. But as we have branched into multi-asset class, then yeah, in that case, it's follow the factors that into places where it's actually working, and try to sprinkle in a healthy bit of skepticism.
And then in practice, how, if this is all the case, and it really starts with asset classes in some sense, because of, I would guess, is in part a legacy issue and the ability to explain it to somebody. Although business schools have been creating courses, and we run a course at Wharton that's heavily factor-oriented. In fact, a number of courses are. Is that a function of a principal agent problem, ultimately? And in either case, if the answer is yes or no, how do you size the non-asset class effects that are away from the benchmark? Let me start with Rob.
No idea. No idea. I think the great thing about factor investing overall is, as we sit here doing our research, we try to figure out what we don't know and start there. I think Cam actually had, wherever he is out here, had some really good, how to take results and discount it. And I think it starts with, a lot of the questions you're talking about. Actually, I don't know.
Mm-hmm. But you must have an idea, sort of a forecast or an idea of how much non-benchmark risk your clients want you to take.
I think clients want nirvana. They want to win, they want to take the least amount of risk, and they want to be totally explainable. And I would actually argue a little bit with what you heard on the last panel of the discussion, that part of the reason for generating economic rationale behind what we do at the factor side is that clients, you can't just say, well, I don't know why it works, it just works. That's what the math tells me. Usually a client says, well, you kind of need to give me something more than that, because I got to go talk to a board and I got to tell them that, you're really smart, you did all this research, and you think that the following works because. Mm-hmm. And so that because gets to be a little more important from an asset owner's perspective, I would presume.
So from the tracking error side, I would say somewhere between 3 to 7, 8%, as high as that. We have looked at that. And then again, if you have a low wall bias, so that includes a lot of tracking error. Again, at the same time, how much lower beta that we want to have, because overall, it's definitely lowering your beta in some ways. And again, are we comfortable with that? So we definitely spend time on some of those things. And at the same time, if these factors generally will not go wrong at the same time, but it does happen. How bad it can be, definitely we look at those things.
So I think there is a principal agent problem, but let's call it a challenge. But I think the biggest challenge is not between the CIO and the asset manager, but rather, as Rob alluded to, the CIO and the board. So people who are focused on the financial markets on a daily basis, many of them get it, and many of them probably because they had good training in your program and elsewhere. Where they struggle is how do they go from this is what we understand to being able to explain it to people who are very smart but don't spend all day thinking about this, and that's where the principal agent problem comes in. If they drastically underperform the S&P 500 when, say, the S&P 500 has a 30% year like a couple of years ago, that's a benchmark problem. That presents career risk for a CIO. And that's where I think the big principal agent problem comes in.
And I would say it's true on the factor definitional side too. In fact, you heard a discussion over here of, spring of 2009. Well, junk rallied, so you would presume quality minus junk would suffer. I think there's this descriptive problem where people don't particularly understand the short bet when most of their assets are long only, and they're trying to describe it as a factor, and they're saying, well, momentum worked or quality worked, and why didn't you? Well, you kind of forget. You have to look at what you didn't short, what you couldn't short. So I think there's a definitional problem there as well, which complicates the discussion, CIO to a board.
I would add to what Jeff said. So we spent over 2 years, I would say, talking to the trustees. We had a derivative overlay program for that one, and again the fact.
So an overlay program?
Yes, to explaining them then why are we doing it, and why it helps us, and when it will not help us, in what are the times. And it was, I would say, when people have asked me how did you go about it, again, it's not an easy process. Every quarterly meeting we will just talk about it, trying to educate them. And at the same time, I would say, and again, there is a turnover in the board also, so that also makes it sometimes complex. But that's the first place you have to start, I guess. Anybody is looking into that side.
Could you ever have a conversation about running, equitizing beta using future swaps or derivatives, and then going to your active managers and running the risk of everyone at 12% and just combining everything into an overlay portfolio?
Well, we, not to that extent, but again, for them to educate why we should be having a futures program. Well, nowadays it's become so expensive for us that, I don't know if some of you might be aware of, futures are now, because of the Dodd-Frank. But again, to educating them, and again, how we can get these risk premium in the market. And then even the swap market, we can get some of that if we want a pure factor exposure. So once they have that understanding, it makes it easier for us to make what factor we want and why.
And is it a new conversation? Is this part of a new conversation that's arisen recently, or is this something
it's been on the last 4 years. I've been there almost 5 years. So first 2 years we just spent all the time talking about these things.
Sorry, Syed. I was just going to say, I think what we have seen in terms of a new conversation is we've started to see a lot of asset owners come and say, well, maybe rather than restricting each individual asset manager at some level of risk, maybe we'll control it at the upper level, let the manager take as much risk as they feel comfortable, as much risk as they can provide, higher Sharpe ratios or information ratios, whichever direction the asset owner wants to go. And then we, the plan, will control risk. So if you want to take a tracking error of 12, take it. Of course, as an asset manager, if you want to triple check to make sure that the client, are you sure you can take that risk? Are you sure you're going to take that risk? You're not going to fire me with my tracking error of 12 when I dip. And under those circumstances, I think that is a newer conversation, particularly post the sort of de-risking that you've seen in a lot of the defined benefit space in the last couple of years, perhaps with UPS as an exception.
And we have one manager who has a beta of 0.6, active manager, 0.6 beta. So as you can imagine, last 5 years number has been not that pretty. But again, he's still in the portfolio. So as long as our board understood that, we were comfortable with that, there were the reasons for that manager.
Jeff, do you have anything to
We're seeing the same thing, that risk in theory gets managed at the asset owner level as opposed to the asset manager level. But I worry about what Rob was alluding to as well, which is time and consistent preferences. It's one thing to say it is most efficient from a capital perspective to take as much risk from your active managers and less risk in passive parts of the portfolio. But that does introduce career risk when you have as you said, a 12% tracking error, and with statistical likelihood, there are going to be down periods that are both extended and deep.
one of the most exciting developments in practice might, in some sense, be called a democratization of the factor approach, or a spreading of the religion, in the words of others. We'll hear later today in our closing panel about smart beta, its controversies and some opinions surrounding it as an example. But let me ask you, as institutional investors, what you think about the source of the return effects you've described. Are there risks that are only available, say, in some vehicles, some investment structures, types of managers, maybe some kinds of incentive contracts, for example, in the case, Rob, that you just mentioned? For example, are there only risks that are available in hedge funds? Are there only risks that are available in certain contexts from an investor's perspective?
Yeah, I mean, I think anytime there's more people looking at something, you run an increased level of risk, crowded trades, whatever you want to articulate it. Now, I think it also makes money managers better to have, lots of different potential solutions. Rather than hiring an active manager, you can get a bunch of different passive exposures and add them up and get what I do for half the price. Well, that's bad for me. So I think it's probably good for asset owners on balance. But having said that, it does create some knock-on risks that I think perhaps groups like this really need to spend some time understanding. We talked about some of them last night at the dinner, where some of these passive smart related strategies actually create some derivatives related risks, where there's derivative contracts being written and then underlying cash equity transactions going underneath, so you get this sort of tail wags the dog effect, which can really have distortions at least in the equity and derivatives markets.
The question is, are there only certain kinds of risks that or access to trades that you find valuable, for example, in your work, only in certain structures? For example, in the less benchmark-connected world of hedge funds, where presumably, theoretically, although we know it's not true, active risk is potentially all of the risk budget.
No, in the hedge fund structure, like risk premia, we have looked at that, and we are actively, saying that, okay, in that structure, can we get a multi-asset framework? But at the same time, the question that I sometimes struggle is that if I have an equity portfolio, and these already have a factor bets, so which is, if I'm X the market factor, then now I have a value, let's say momentum, all that. Now in my risk premium, I'm doing a similarly thing on my hedge fund. I'm double loading all these factors. So again, these are the things that we have to be aware of. And that's one of the things we have. And again, a lot of the risk premium does have a pretty large component of factor exposure coming from the equity factors. So,
Jeff, you work at a well-known hedge fund. What are your thoughts?
Yeah, I think that's right. I wouldn't say that there's exactly one way to garner access to these risk factors. I think the less constrained you are, the more pure you can express your views. So if you're looking at it from a benchmark perspective, or particularly a long-only benchmark type perspective, you're going to pick up some of the factor that you're trying to get, or even several of the factors that you're trying to get exposure to, but you're going to be picking up a lot of other risk factors that are either unintentional or that you can get much cheaper and much more efficiently. So from the hedge fund perspective, it's nice to be able to say, I'm going to be, as much as possible, neutral to asset class betas, because those are easy to get, cheap, not free, and just express pure views on the risk factors that one might consider as close to optimal as one can get in an asset allocation framework. That said, I welcome it. I think it's great that the democratization of risk factor investing is happening, because sure, it might challenge some hedge fund managers, but it also forces managers who are charging hedge fund fees to deliver things that are really uncorrelated, that's idiosyncratic alpha, and differentiating from risk factors that maybe 20 years ago were hard to access, but today is much easier to access in multiple formats.
Do you anticipate compensation contracts changing?
One would hope so, but I tend to believe that there's a lot of hysteresis in how incentive contracts and how contracts in general are created, so I tend to doubt it.
Do you see more 0 and 30 kinds of mandates across the board, even for benchmark managers? I mean, for the whole panel? Or, sort of a lot of the upside?
Up from a very low base, yeah. I'd say there's more, but it's still off a low base.
It's still off a base, okay. What kind of tools do you use in your practices to capture the effects that you've outlined, Rob?
Well, I think there's a whole host of off-the-shelf tools. I think you have to be careful of those, the biases that come with them. But everything from the Northfields and the bars and the FactSets and the Axiomas of the world to the proprietary, and I'm sure everybody here uses some form of either alpha or statistical or alpha or risk model proprietary. We certainly do. So I think it's a.
Is the idea to understand what everyone else knows? You're extracting out a benchmark that is just not the class of asset defined, but it's really just against what is usually out there?
Yeah, I mean, we think of it in a couple of different ways. First, on the risk model side, we want the best way to eliminate risks we don't intend to bet on. So we tend to favor statistical risk models in that case as opposed to fundamental. On the alpha side, though, fundamental risk models are just, again, easier to explain to the asset owner. So I think we sort of think about it that way. And then when you combine the two, if you come into a job and your boss, bought Bara and that's a system you have, there's all kinds of unintended risks that you get by simply using that risk model because that's just what you got. And so I think the ability to look and see what all the different choices are and compare and contrast against the alpha model that you're using, whatever that is, different amongst the three of us, I'm sure, I think is an important thing to do.
Mm-hmm, mm-hmm. I don't have any alpha model, so okay. So for the risk model, we look at Axioma and some of the internal tools that we have.
Mm-hmm, mm-hmm. And you evaluate manager alpha by
Farmer French, 4 factors. We definitely look at those. So again, one of the reasons when I joined, I said, okay, every manager we have to go through that exercise. And again, well, it was not. Cam Harvey, anybody who was at least 2 T-stats of 2 and above on alpha side, then only, again, what's happening. So we did whole of that. To give you an idea, a few years back, 5-7 years back, UPS used to have 16 small cap managers. So what does it mean? It means
16 small cap managers?
Yes, what does it mean? So it's expensive Russell 2000. So we try to move away from that, and again, do it much more, again, given our scale and size, we can do it at a very cheap cost, so that fees is very important for us, as low fee as possible, because that's the constant. So these are the things that we look at.
Fees are alpha, they just have the wrong sign. Okay, and Jeff?
Us managers are trying not to laugh too hard.
I think a lot of people just look down for a
Sort
second.
of a tough laugh.
I don't know that I want to add anything beyond that one. Yeah, I think that's right. Where do we source this information? As you said at the beginning, we're a technology company, and as such, we source the information wherever we can get it. As much data as you can ingest as possible, the better you can measure things, both from a risk perspective and from a forecasting perspective, the more comfortable we are with the intentional and preferably lack of unintentional bets that we take.
I'm going to ask one last question before we open it up to the audience, which is, much of today's discussion has naturally, although perhaps incompletely, focused on what might be termed the asset side of the firm total balance sheet. And that is true almost certainly for institutions and individuals alike. Is it not important to consider the systematic correlates of liabilities? Syed, you mentioned it briefly in your opening, but can you say something about that?
It is very important. Long duration, because 17 is duration, so that, and again, especially where the rates are these days. And at the same time, the parent hasn't come to us and said that, okay, we don't care, okay, 8.75 is important, but funding status, they have said don't care about that. They haven't said that also. Mm-hmm. So for us, it becomes a very challenging problem that we can't just be, okay, on the return-seeking side. We have to have an asset for the liability hedging, but how much we should be having. And again, if there is some feature that has correlation to the liability, we like that feature on the equity side. Mm-hmm. And that's why we had the low wall bias that I mentioned initially. But again, for us, it is very important. Especially now, the funding status right now, we are around 79. So that, the amount of PGVC premium that we have to pay, all that, so for us, I would say we are definitely aware of that and work around that.
Mm-hmm. And do you link it specifically to factors on the, beyond sort of duration and kind of, sort of just interest rate oriented immunization ideas? Do you link it to the other factors, value and growth, and do you characterize UPS as a firm?
In the fixed income side, no, we haven't looked those factors. But in the equity side, yes, how do they do, when my duration is behaving certain way, so like whether it's value or small cap or low vol or quality, so we definitely look at that.
Great.
Yeah, I mean, we don't, we're not the asset owner. I think that the point is that if you have an opportunity to share some of that liability research with or liability characteristics with your manager, I think that's always better because it may change what the manager does a little bit, and I know that's certainly the case for us.
I think that's true, but we have the same problem with time inconsistent preferences, which is when times are, during periods of equity market, in particular drawdowns, people are very focused on liabilities, and you heard a lot about liability-driven investing 5 years ago. When times are good, then it's less focused on liabilities and more on keeping up with the Joneses, or how do I do relative to my peers, how do I do relative to the overall market?
Yeah, at the end of the day. Okay, many thanks, gentlemen. Now I'd like to open the dialogue to our audience. There was a question right up front here.
I have been, for last 2 or 3 years, keeping up with financial development and research, and especially about factor investing. The panel has just talked about their involvement in factors. And frankly, my experience is that most of the people that I go to are professional people who manage money. They have no idea about factor investing. They just keep on coming back to the same concept of asset allocation, and they compare themselves with a benchmark. The idea is to beat the benchmark. The markets are not efficient. They're supposed to be, but they're not efficient. There are a lot of factors that make them inefficient, and the idea is to take advantage of those inefficiencies. I have not met anyone except one company that has built up a model which is directly focused on factor investing. So I want to ask from the three of you, since you are actually dealing with a lot of clients, do you offer any focused factor investing that gives an edge to your product?
All of us here are factor-based investors. We all run firms or have plans that focus on factor investing. Chris probably wouldn't have invited us if we'd been, particularly poor at what we do. But in general, I think that you make a lot of really good points, that factor investing is a way to provide some sort of differentiated excess return, for lack of a better term, and certainly not speaking for the rest of them, but it's something we believe in at my firm.
Well, for us, because we have $30 billion in pension plans, so we can partner with in the industry, and if we want to, what factors we want, how we want, that can be done. So for us, it's a different kind of problem. So.
Well, more than anything, I'm disturbed to hear that a lot of financial advisors just don't think about risk factor investing. Clearly this is not a representative audience, but it's fair to say that I tend to overestimate the spread of knowledge on topics that have been around for 10s, 20s, and even hundreds of years, potentially, depending on how you define it. One might assume that it's common knowledge at this point, but clearly it is not.
What about the extent of the democratization? I mean, in some sense, you serve at least, I would guess, large parts of your business come from defined benefit plans or other pools of capital that are fairly large. What about the defined contribution? Are we seeing reflections of factor investing showing up in defined contribution settings, or will we?
Yeah, I think you are. I think there's a big movement of defined contribution matching off the level of sophistication, the tools used, et cetera, that's on the defined benefit side. Certainly we've seen that. I think that's absolutely happening. But back to Jeff's point, at the end of the day, it's just a lot sexier in the newspaper to see some guy stand up in front of a conference and say, I have a dream for a particular stock. This is the greatest stock ever, and it's going to go up. And then everybody watch the newspaper for the next month to see if that happens. It's just, it's a little, you see all the formulas that were up on the screen earlier, and, you start to see people sort of fall asleep. And it's not as sexy, and that's good for us.
In this audience, that is very sexy.
Well, true. But I think to his point about the industry at large, and I think that's actually good for us. That maybe provides job security for those of us in the room. So
Barriers to entry. Okay, excellent questions. Yeah, right here, Prakash.
In addition to the factors, do you take the tactical tilts into account, such as like some kind of like Bridgewater's like currency bet they did in the first quarter, where they were long US dollars, short with a very diversified basket of all the other emerging as well as European currencies. And that kind of pumped up their alpha return to about 13-14%. So is that a part of your strategy, or you guys don't, you have an equity-based strategy that's what you focus on?
You want to start, Jeff?
Well, I can't speak to any of our strategies in particular, but the way you described it seems to be more of a less of a factor and more of either an alpha type play. In other words, it's a non-factor, systematically factor-based orientation.
Yeah, from our perspective, we both define factors a little bit differently to try to get a little, as I said earlier, a little bit of asset selection return. But yes, we do tilt to and away to some degree based on the circumstances of the environment.
Let me ask it in a way that is a little bit less masked. What, when you're trading international equities, are you taking carry trade risk, currency carry risk? Are you tilting to sort of effects that might be kind of, I don't know, in some sense secondary, but maybe very impactful for alpha?
Yeah, I think particularly if you're long only, you're definitely taking other risks. There's no doubt. Yeah. And you're just hoping that they're risks you want to take.
Okay, good. Questions? Yeah, right here.
Whether it be alpha or factor-based, communication with boards and asset owners, in terms of, you mentioned, turnover on boards, talking to people who aren't thinking about these kinds of factors on a daily basis. What do you see, do you see trends in increasing knowledge about these things? Do they understand risk budgeting? Do they understand saying, hey, it doesn't matter if the S&P went up 30% this year, that's not how we should assess an asset manager. What's your experience in educating folks?
So the last part, they do understand some part of that, but all of the, in our case at least, the trustees have a full-time, they are senior executives, and they have, on the finance side, they have full-time jobs, so this is a part-time. Though we are trying to get them more involved because of the size, but it's a challenging thing. It's, the moment you get into that, and we are trying now, in fact, we had a oversight committee a few days back, and now we are trying to have one-to-one conversation so that they can sit with us instead of coming for 2 hours, 4 hours, and then cramming them with so much information, then they are lost. So again, it's an educational process. I don't think it's easy. It's going to take way more time.
It's definitely going in the right way. You just look at the pedigree of the people in the room, and Syed, the amount of information and knowledge at the asset owner level, at least in regards to the kinds of factor-related discussion we're having here on the panel, has certainly gone up in the last 15 or 20 years, no doubt.
And that's a plus from your perspective?
Yeah, absolutely. Yeah, absolutely.
So is it a democratization of the alpha as well?
I think that's certainly, there's a couple of folks in the room who would have a whole business model based on that, which have done pretty well. So yeah, I think absolutely that's happening. But I think if you're a manager, you always appreciate someone asking good questions about what you do. And if you're an asset owner, you want to make sure you're asking those questions. So I think it's net it's a good thing across the board.
Okay, thanks. Questions?
Factor investing tends to be very micro or bottom up. How do you incorporate macro influences into your factor investing?
Excellent question. So the question was, what we've discussed so far sounds micro. It's HML, SMB, kind of the standard micro. What about some of the classic macro factors, including General and Ross, shocks to industrial production, other things? Well, I think Prakash sort of alluded to some of that.
So it depends on the instrument you're trading. In the equity space, it's a lot easier to be micro. As you get towards more macro type instruments, futures, particularly futures on commodities, currencies, there are macro type factors that you want to be considering there. And in fact, I would argue that one of the oldest factors around is the FX, foreign exchange value model. And that you could date back to the 16th century school of Salamanca, in which you're looking at the underlying macroeconomic drivers of currency differences.
Yeah, I would say there's a couple of ways. One, you heard about macro issues sometimes as the articulation or the explanation for what drives a factor in the first place. So you could almost argue that sometimes a factor is related to, in some fashion, a macroeconomic variable. On the other hand, I think where a lot of factor investors, tend to use it the most is in helping them organize some sort of tilts. To the previous question, you'd be tilting to or from particular factors given macro environments. And then I would imagine that certainly most of the active traders in the room, ourselves included, there's no doubt that macro-related issues in the immediate term, be they FX changes or something like that, can affect a trading strategy, which is sort of around a more structural investment strategy.
Is it important for us to spend a lot of time thinking about whether a factor or a source of premium is an alpha or a beta?
Well, from the cost side, yes.
We want to spend a lot of time and hope
We-
we don't
every
find the
basis point
difference.
for us is important,
We
so.
find a big difference, yeah.
I think the definition of alpha and beta have changed over time. And you talk about the democratization of factor investing. That to me is the democratization of factor investing. 20 years ago, a hedge fund manager might be able to get away with charging hedge fund fees for value tilt, momentum, what have you. As people become more aware of this, what had been considered alpha is no longer considered alpha.
And has that changed fees?
You can ask that, and yet you ask what's a standard hedge fund fee today versus a standard hedge fund fee 20 years ago. It's still probably 2 and 20. That said, and I actually welcome this, even though it might sound a little counter to my interests, it changes what hedge funds can do. So hedge funds that used to be able to get away with doing that no longer can. So the bar, I think the bar is continually going up. And from the asset owner perspective, I would assume that's a good thing.
Okay. All right, we can take one more question. Ken.
We can't let this panel end without addressing the elephant in the room. Jeff, in light of Cam Harvey's talk, will you be changing the name of your firm to 3 Sigma?
It's safe to say that decision is not up to me.
Or close version, 3, but not higher than 4. There are a lot of people in today's audience with experience, exposure, and interest in the ideas you've elucidated. There are trillions of dollars of investment capital being implemented in the manner in which you described. What are you excited about? What are you concerned about? Jeff?
So excited about a lot of things, mostly excited about the fact that people are thinking about this, that they're thinking about their portfolios in risk terms, because the net result of that is more efficient portfolios. And I speak in part from the asset manager perspective on that, and in part as someone whose family is tied to a public pension fund and who retired and therefore hopes that asset allocators can more efficiently manage their portfolios. On the not excited front, or even the scared front, people know the finance industry. Lots of people tend to run to the bright, new, shiny object. Factor investing is not a golden goose. It's not going to generate these great returns forever. It is about taking risks. And my fear, among others, is that people are going to run towards this without fully understanding what's involved. They're going to realize returns that are not unexpected had their eyes been open in the process of going in that direction, but suddenly decide to reverse course, and to their detriment.
So factor investing, so what is guaranteed? Factor exposure. Returns are not guaranteed. So, and again, what I sometimes fear is that there will be so many products coming up, and for people who are not, for them, it might look that they have done well in the past, and that might, so that kind of risk, sometimes I think about that, especially on the retail side. And it looks like, and there is so many products coming up, there is a race to that. So that's the risk that I see there. But at the same time, if there are efficient ways to, these products are available from these risk premia, and again, at a very easy and a cost-effective way, then why not? I think it's a good thing in a way.
Then why not? It's a good thing. Okay.
Yeah, I agree. I think in terms of what's exciting, new sources of data, new places to go to apply it, new tools to use. I think those are all things that, at least we get excited about, and I'm assuming everyone in the room as well. There are risks. These guys mentioned them, but I would say that sort of an extension of what Jeff said, oversimplification or unintended risks. You know, I mentioned earlier some of the, you know, derivatives contracts that, oh, you can get a factor and here it is, but it's long only and it's pretty clumsily applied. You know, I think those are some pretty big risks that there's probably enough definitions of factors as there are people in the room to describe them. So I think oversimplification is very dangerous.
So a cacophony of effects for investors to sort through and to disentangle. But gentlemen, thank you so much for your contributions.